In our previous videos, we have been looking at the different types of exchange rates. So we've looked at a fixed exchange rate, and that was when Canada, for example, was on the gold standard. We have looked at pegged exchange rates. So the Chinese yuan is pegged to a bundle of international currencies. In fact, the Canadian dollar was pegged to the US dollar. And in fact, we can see that here in the 60s. And the last two types of exchange rates we want to look at are the managed float and the flexible exchange rate. Canada right now is a managed float, so is the US dollar. Now, a truly flexible exchange rate would have the exchange rate be determined solely based on supply and demand setting the value. A managed float is where we have that flexible exchange rate determining the value, but then we can manipulate it using monetary policy to encourage that exchange rate to be within what we consider to be an optimal range. So let's look at how the managed float and the flexible exchange rate work. And you can see here in the last couple decades, you can see that managed float, how it's moving around. Because it is a somewhat flexible exchange rate, it can have a lot of volatility. So you can see that the Canadian dollar has been on par with the US dollar, and it's been as low as about 65 cents in the last 2 decades. We manage the float by trying to keep it really more in this range here is more of the ideal. And so let's look at then how that works. So a flexible exchange rate has the value of the exchange rate set by supply and demand. So when we look at demand here, this would be demand for Canadian dollars. And the people who demand Canadian dollars are the people who are in other countries. So when Americans want to travel to Canada, they demand Canadian dollars. Then we have the supply for Canadian dollars. And so that would be Canadians putting Canadian dollars out in the rest of the world. So when we travel, for example, we take our Canadian dollars, we trade them for other currencies like the US dollar, and that puts the Canadian dollar out in the rest of the world. So here, for example, we could look at the Canada-US exchange rate. So we can look at 1 Canadian dollar equals 78 cents US. Now, the key here is that the exchange rate of 1 Canadian dollar equals 78 cents US is then tied to the US value, the US dollar in Canadian dollars. And we looked in a previous video how you can go from having 1 Canadian dollar equals X number of US dollars to 1 US dollar equals X number of Canadian dollars. And so because of this tie, when you have a change in demand for a currency, right, change in demand for Canadian dollars, it's going to change the supply of US dollars out in the rest of the world because we have US putting money out in the rest of the world and exchanging it for those Canadian dollars. Same thing for the Canadian dollars. If we supply Canadian dollars out in the rest of the world, that's increasing demand for another foreign currency like the US dollar. So there's this tie between demand for one currency and supply for another. But before we get to that piece, I'll show it out to you on a graph so we can very easily see it. Let's just talk about demand and supply and how it impacts the value of your currency. So if there is an increase in demand for Canadian dollars, then the Canadian dollar will appreciate. So for example, if more Americans want to travel to Canada, it increases the demand for Canadian dollars. It'll make the Canadian dollar go up or appreciate in value. And so we might go from 1 Canadian dollar equals 78 cents US to 1 Canadian dollar equals 80 cents US. So appreciate, gain in value. If we look at this here, here's demand, supply. If Canadians want to travel to the US, there will be an increase in supply of Canadian money out in the world because Canadians are trading it for US dollars. And that is going to cause the value of the Canadian dollar to depreciate. So maybe it goes from 1 Canadian dollar equals 78 cents US to 1 Canadian dollar equals, 75 cents US. So depreciate, decrease in value. So an increase in supply will depreciate the currency. An increase in demand will appreciate the currency. We can also go the other direction. So we could have demand decrease. And what would that do to the value of the currency? Would make the Canadian dollar depreciate or go down. Okay. If there was a decrease in supply of Canadian dollars out in the rest of the world, what would that do to the Canadian dollar? It would make it appreciate. Think about it as if there's less money, less Canadian dollars available, right? It's more rare, it's more valuable. So that decrease in supply out in the rest of the world makes the Canadian dollar appreciate or gain in value relative to the other foreign currency. So we might go from 1 Canadian dollar equals 78 cents US to 1 Canadian dollar equals 80 cents US. So an increase in demand made the Canadian dollar appreciate. A decrease in demand made it depreciate. An increase in supply made it depreciate. And a decrease in supply made it appreciate. So we need to recognize that we're making the value go up or down on the vertical axes here. All right, so we said that the currencies are linked. If one currency is going up, the other one is going down. And that is because the tie between the currencies, because we're looking at an exchange rate, trading one for another. So if Americans, so the US, is demanding more Canadian dollars, then what they are going to do is that they are going to have to trade their US dollars for Canadian dollars. So the supply of US dollars out in the rest of the world goes up. So you can see here the value of the US dollar goes down when the value of the Canadian dollar goes up because our exchange rate is written as one currency for another. So if we go up, 1 Canadian dollar equals 78 cents US, and it goes up to 1 Canadian dollar equals 80 cents US. Okay, so the Canadian dollar is appreciating. Then we can also see here 1 US dollar, so that's 1 divided by 0.78. Let's bring our calculator back here. 1 divided by 0.78, right, is 1.28 US. And when the Canadian dollar appreciates to 80 cents US, then we're now at 1 divided by 0.8. So 1 US dollar equals 1.25 Canadian. Oh, yeah. It's because this should say Canadian. There we go. 0.28 Canadian. So notice here that the Canadian dollar appreciated, the US dollar depreciated, went down in value. And that's because we're trading one currency for another. All right, so that means that when we look at what is impacting our currency, we really just need to focus on determinants of demand. Because determinants of demand, remember, demand for one country's currency will change the supply of another. So you simply need to look at what is changing demand and who is it changing for, US or Canada. Because if we can identify that the demand is changing because of something that's happening to the Americans, that would be demand for our currency. Or we can look at then what's happening to the supply for another country. Well, that's going to depend on the other country's demand. So you only have to look at the demand side because the demand for one changes the supply of the other. So let's break this down. Let's clarify this a bit. by looking at these determinants of demand. And let's look at what's happening with COVID in terms of the US and Canada. And can we predict what is going to be happening to the Canadian dollar? Will the Canadian dollar appreciate, gain in value, or depreciate, decrease in value relative to the US dollar? And we can tie it back to these determinants of demand, because if we look at changes in demand from that exchange rate, remember, changes in demand for one change the supply for another. So let's take a look at this. All right, so let's think about it this way. Demand is the US. Does anything change the amount the Americans want to buy from Canada, the amount the Americans want to travel to Canada? That will all change their demand for Canadian dollars. We will look at Canada. So Canada, we're looking at the supply of Canadian dollars out in the rest of the world, but that's really going to depend on our demand from buying other things from other countries to going to visit other countries. So it really is just a question about demand changing. Canadians' demand for other countries, that'll be the supply of Canadian dollars out in the rest of the world, or US demand for visiting Canada and buying Canadian stuff, that'll be demand for Canadian currency. So let's look at these pieces here. So if we have a completely flexible exchange rate, then it's this list that is going to change the currency. If we have a managed float system, then we have the additional aspect here of manipulating monetary policy. And what are the two parts to monetary policy? Right, we have money supply and we have interest rates. So we can change the money supply and change interest rates to also change this graph. And that's going to tie again to relative prices and to interest rates. So it really does just tie back to these determinants of demand, but it's, are you letting market forces decide them, or is the Bank of Canada intentionally manipulating money supply and interest rates to change these determinants, to change the exchange rate? So let's take a look. Okay, so we need a starting point. So let's talk about what would cause the US to demand more Canadian dollars. So we're looking at what would cause, and I'm just going to actually duplicate this, clone this page. Okay, so let's look at what would cause the Canadian dollar to appreciate. So the Canadian dollar, 1 Canadian dollar equals 78 cents US. We're looking at what would make it go up. All right, so if US demand for Canadian dollars increased, the Canadian dollar would appreciate. Let's say go from 1 Canadian dollar equals 78 cents to, let's say, 80 cents. So what would cause Americans to demand more Canadian dollars? Well, let's go through our list here. Changes in taste. Well, if the US likes Canadian goods more, so there's an increase in preference, they'd rather buy from us, they need Canadian dollars to do so. So a change in preference will change demand. If Americans are getting pay raises, their income is increasing, they can now buy more goods, they can now go on more vacations, they can come see us. So that change in relative income means they can buy more stuff. So that means more imports. They need Canadian money to buy Canadian stuff. Okay, increase in demand for Canadian dollars drives up the Canadian exchange rate. 1 Canadian dollar is now appreciated, gained in value. Now here we have changes in relative prices. Well, we're going to buy from whomever is cheaper. So if the US experiences more inflation, then they would prefer to import more goods from Canada than buying them domestically. So let's say they decide to buy more from us. They decide to buy more from us because our prices are lower. They will need to exchange those US dollars for Canadian dollars, increase demand for Canadian dollars, will cause the Canadian dollar to appreciate, to gain in value relative to the US dollar. The last one we have here is changes in relative interest rates. So we have to look at, who do you want to invest in? Lower interest rates or higher interest rates? Which stocks and bonds would you rather buy? The ones that have a higher rate of return or a lower rate of return? Well, we want to get more return on our investment. And so we are going to then invest with whomever has a higher interest rate. So if Canada raises their interest rates, then Americans will want to invest in Canada where they can get a greater rate of return on their investment. They will need Canadian dollars to do so. So they increase demand for the Canadian dollar. It causes the Canadian dollar to gain value, to appreciate. All right, so we talked about how all of these would change the Canadian dollar. Americans liked our stuff better. Their income went up. If there was more inflation in the US, and if interest rates went up in Canada. Okay, that last determinant of demand that you see here is speculation. This is the idea that you buy low, sell high, and so you're trying to predict what will happen to the value of the Canadian dollar. So when it is lower, you then demand more Canadian dollars so that you can sell it when it's higher. And of course, that increase in demand for Canadian dollars will also cause it to go up in value. All right, so all of these were from the perspective of the US needing Canadian dollars. So we were changing demand. But we can also look at it from the supply perspective, because as we know, changing demand for one changes the supply for the other, or changing supply of one changes the demand for the other. So let's go the other direction. Let's look at what would cause if Canada was to supply more Canadian dollars out into the world. Okay, so this is Canada putting more Canadian dollars out in the world, which means they are demanding more of other countries' currencies because they want to go there, because they want to buy their stuff. So here we have 1 Canadian dollar equals 78 cents US. The increase in supply of Canadian dollars out in the rest of the world will cause the Canadian dollar to depreciate, to decrease in value. So let's look at what would cause that. All right. Well, what if we Canadians, what if we like US goods more? So we decide we want to buy more American goods. We need to demand more American dollars and put our Canadian dollars out in the rest of the world to get those US dollars to buy those US goods. So that's an increase in demand for US dollars and an increase in supply of Canadian dollars out in the rest of the world. Changes in relative income. What would cause us to buy more US goods, import more from the US? Well, if our incomes went up, so domestically the Canadian income went up, we would then buy more from other countries, which means we need to put more Canadian dollars out to get those US dollars to buy those US goods. Okay. We can look at changes in relative price levels. Okay. So again, we're back to buying from whomever is the cheapest. If prices in the US are low, so we have more inflation in Canada than they do in the US, if prices are cheaper in the US, then we will buy more US goods, import more, and buy less domestically. It'll increase the supply of Canadian goods out in the rest of the world. We're trading them for the US dollars to buy those cheaper US products. So more inflation in Canada increases the supply of Canadian dollars out in the world, depreciates the Canadian dollar. If there's more inflation in the US, then the Americans are buying from us instead, making the Canadian dollar appreciate. So you can see how it's the opposite impact on the exchange rate. Then we have changes in relative interest rates. Again, we're going to invest with whomever gives us the best rate of return. If the US increases their interest rates, we'd rather buy US stocks and bonds instead of Canadian ones. And so then we need to take our Canadian money, exchange it out for US dollars. That increases the demand for US currency, increases the supply of Canadian currency out in the rest of the world, makes the Canadian dollar depreciate. Okay. And then again, speculation, buy low, sell high, depending on who and what currency you think is low and is going to increase in value, will cause you to change. As you trade one currency for another, it's changing supply for your currency as you demand more of another currency. Okay, so let's look at COVID. What is happening with COVID? So the current exchange rate, this is November 2021. So we've been going through COVID for over 18 months. So we've already seen a change in the exchange rate because of some of these things that we're talking about. But let's carry it through and look at the next while in terms of what we think will happen to the Canadian dollar because of what's happening with COVID. So will the Canadian dollar appreciate, gain in value, or depreciate, go down in value relative to the US dollar? Well, this really takes us back to that list of determinants. So changes in taste. Who is going to reduce their travel restrictions first? If the US reduces travel restrictions first, then Canadians can go to the US. To do that, they're going to have to put their Canadian dollars out in the world because they're going to demand more US dollars. If the US is able to travel to Canada first, Americans will demand more Canadian dollars so they can visit us and buy our stuff. So which one do you think is going to happen first? Well, we've already seen a bit of this already, right? We saw that the Canadian border allowed US people in first before the US allowed Canadians in. So based on that, what we see then is that the US will demand more Canadian dollars, and it causes the Canadian dollar to appreciate. In fact, we've seen over the last couple months, the Canadian dollar has appreciated, gone from about 75 cents US to 78 cents. So the question will be, what will happen next? As of November 2021, we have additional variants of COVID that are popping up that could close borders. Just in the last couple days, Omicron, I think, is the latest COVID variant, is caused throughout Europe, UK, Israel, to close their borders again. This impacts their exchange rate because we have to look at, are others able to visit and to buy your goods and services? Because if other countries demand more of your goods and want to come visit, they will need your currency, which drives up the value of your currency. So here the Canadian dollar appreciating. So the question will be, is further opening of the border between Canada and the US, will it be more Canada? And if it is more Canada, the US coming to Canada, the Canadian dollar will appreciate. If instead we have more Canadians traveling to the US, they will trade those Canadian dollars for US dollars, and the Canadian dollar will depreciate. All right, let's look at what else could change. The second is change in relative income. So we need to ask ourselves, which economy will recover first? Okay, so who's going to see a rebound in terms of jobs and pay, and who's going to see greater increases in income? Who's going to see more economic growth, quicker, faster, bigger? Whoever is seeing that rebound will then be the one who spends. If it's Canada seeing a greater increase in their income, they're going to then supply the Canadian dollars out in the rest of the world so they can buy US goods and bring them back. In that case, increase in supply of Canadian dollars in the rest of the world, the Canadian dollar will depreciate. If it's the US that rebounds first, they're going to travel to Canada, they're going to buy Canadian goods, they demand Canadian dollars to do so, the Canadian dollar appreciates. So which do you think is going to happen first? Who's going to see that increase in foreign purchases first? Some people have argued that it's going to be the US, just because of the quantity of government funding that has gone in terms of support. So checks in the mail to Americans to help boost their spending and help them pay the bills and cover that. There's been 3 of those payments. Now in Canada, we have CERB, which it, also provided some supplementary income to those who were laid off or on leave of absence because of business closures. In the US, those checks went to everybody, so more widespread, which means they might lead to more spending on non-necessities, right? Now, you didn't get laid off. You were still working throughout COVID, but you got a $2,000 check in the mail. You're now more likely to travel to buy extra items instead of just paying off the bills that you couldn't afford to pay off during the lockdown period. So it is possible that the US and their methods of widespread spending on everyone could lead to more foreign purchases, increased demand for Canadian dollars to buy Canadian stuff to visit Canada, and that would make the Canadian dollar appreciate. There's also some challenge, of course, because Canada was having issues with oil prices being low before COVID, and so the Canadian economy was a bit more depressed than the US economy pre-COVID. And so again, it's quite possible the US rebounds quicker because they're not having to recover from the contraction of the economy prior to COVID-19. All right, what else is going on? As we talked about the US stimulus checks, in total, the US spent about 25% of its GDP on stimulus. And so that is expected to lead to an increase in demand for goods and services with all that extra cash flowing around. And this brings us back to the idea of this manipulated, managed float idea versus just a flexible exchange rate, because we can actually manage the float by changing how much cash is out in circulation. In this case, this spending is fiscal policy to stimulate the economy and to help people during COVID. But the Bank of Canada, the Federal Reserve of the US, can just as easily change the amount of cash in circulation, change the money supply to create a similar impact, right? How easy is it for people to get money to spend? And that comes back right to this change in income. It also will change interest rates in terms of how easy is it for people to get cash, because if people have cash, they will spend it. If you have more money in your pocket, more income, you will spend it. If interest rates are lower, you're more likely to borrow. But if you are investing in terms of retirement, in terms of buying stocks and bonds, you're going to look for the higher interest rate. So those types of things will impact how much we need a foreign currency and how much of our currency goes out into the rest of the world. So we can manage and change that exchange rate by manipulating some of these here through our monetary policy. All right. So that brings us to the discussion here of who's going to have more inflation, because of course monetary policy can be used to fight inflation. It can be used to encourage economic growth. So we can look at, well, who's going to see more inflation? That's going to determine what's going to happen to the Canadian dollar. So remember, we're going to buy less from the place with the higher prices. So we need to look at, well, who do we think is going to have more inflation? With all of the US stimulus, there's a lot of comment that the US is going to have a lot of inflation. As of November 2021, we are seeing inflation rates for the year 2021 in both Canada and the US getting close to the 5% level. And as we've discussed in previous videos, we know that the inflation in Canada, we try to keep between that 1% and 3%. If Canada experiences more inflation than the US, then us in Canada, we would rather buy from the US, which means we take our Canadian dollars, we trade them for US dollars, so the supply of Canadian dollars out in the rest of the world increases and it pushes the Canadian dollar down relative to the US dollar. If instead we think that all the stimulus spending in the US is going to be causing more inflation there, then it's the Americans who'd rather buy from us because we are cheaper. Demand for Canadian dollars goes up, and that would make the value of the Canadian dollar appreciate. That's why all these people are trying to guess what's going to happen with inflation. It's then going to change our exchange rate as well. So we know that when there's inflation, we change interest rates to help fight off that inflation. And it's the relative interest rate between Canada and the US, so when we compare those rates of return, that will also impact the Canadian dollar. So we have to talk about who we think will raise interest rates first, and that will tell us what's going to happen to the exchange rate. So we're going to invest in a place with higher interest rates. If we think that the Bank of Canada is going to move first on raising interest rates, then what you're going to see is Americans are going to want to invest with us. So they demand more Canadian dollars, causes the Canadian dollar to appreciate. If we think that the US will raise interest rates first, then we'd rather invest our money with them. In order to invest in US stocks and bonds, we need to trade our Canadian dollars for US dollars, which will make the Canadian dollar depreciate. So lots of speculation right now in terms of who is going to raise interest rates first. Will it be Canada? Will it be the US? All right, so we've talked about tastes and income and tying that to economic growth. We've looked at prices and inflation. We've looked at interest rates. And then, of course, the last determinant of demand is speculation, those who are trying to take advantage of buying low and selling high. So if we look at all these pieces, we can try to predict what's going to happen to the Canadian dollar. Do you think that the US is going to demand more Canadian dollars, causing the Canadian dollar to appreciate? Or do you think that Canada is going to want to buy and visit the US more and invest in the US more, in which case we're going to supply Canadian dollars to the rest of the world to get those US dollars, causing the Canadian dollar to depreciate? So when you put all these factors together, you can start to then make some predictions as to what's going to be happening to the Canadian dollar. We can look at here what has been happening to the Canadian dollar. So we said the current exchange rate is 78 cents US, and we can use the Big Mac index, which we've talked about in earlier videos, to see how it compares to what purchasing power parity says that it should be. And purchasing power parity, so if we're looking at the cost of the Big Mac being $6.77 Canadian versus $5.65 US, then the exchange rate should be 1 Canadian dollar equals 83 cents US. It's actually 78 cents US. So if we were to take advantage of arbitrage, we can see that the Canadian dollar is undervalued. What it is lower than what it should be. So we can expect the Canadian dollar will likely go up if they're through the use of speculation and arbitrage towards more purchasing power parity. We can look as well at what's been happening with the Canadian dollar over time. So you can see here we are about that 78 cents. And you can see throughout 2020, the Canadian dollar was appreciating for the number of things we were talking about there. And then you can see it's kind of flattened out a bit here. So you can look at the determinants of demand to determine what is going to happen to that Canadian dollar. Will it appreciate or depreciate? We can also look at our managed float in terms of what we expect to happen with the money supply and with interest rates within Canada and within the US, which will also impact that exchange rate. So for example, if the Bank of Canada decides to raise interest rates before the US, we know Americans will want to invest with us. Canadian dollar will appreciate. If the US raises interest rates first, then the Canadian dollar will depreciate. If the Bank of Canada reduces its quantitative easing, which it's been doing, reduces the money supply in circulation, okay, it's trying to damp down the amount of inflation, less money to spend, lower prices, those things are going to impact the exchange rate. So changes in the money supply will change how much our currency is relative to another. Lastly, we want to look at what are the pros and cons of having a flexible exchange rate. So if you are truly a flexible exchange rate and not a managed float, there's no direct intervention necessary. It is supply and demand that will set the value of your currency. It doesn't require you to sacrifice your monetary policy in order to maintain it. Now, the downside, of course, is there can be a lot of uncertainty, a lot of variability. So we don't want to solely be a flexible exchange rate because that's too much volatility. We don't want to be a pegged exchange rate because then we sacrifice all of our monetary policy in order to maintain that peg. So what we try to do is find a compromise between, which is that managed float. So we'll periodically manipulate monetary policy to manipulate the exchange rate, and other times we're using monetary policy for the economy. So with the purely flexible exchange rate, that monetary policy can be used solely for stimulating growth or fighting inflation. With the managed float, it's a bit of a compromise against. The flexible exchange rate protects countries from inflationary pressures. So you could see that when we had inflation within our country, with higher prices here, we were buying more foreign goods, which was causing the Canadian dollar relative to US to fall. So when prices went up, okay, the Canadian dollar relative to other currencies went down. And so because there is that relationship between inflation and the exchange rates, it helps protect us a bit from that inflation in terms of our ability to get other goods in other countries. So pros, no direct intervention. If we have flexible, we can keep our monetary policy for stimulus and reduction of inflation. We can protect against the inflationary pressures. Downside, a purely flexible exchange rate has that uncertainty and volatility, and the exchange rate may be a rate that is not advantageous for our trade. And so, for example, in Canada, if the Canadian dollar appreciates, gains in value, it hurts our manufacturing industry. So if we look at Ontario, Manitoba, Quebec, southern parts of Alberta that do more manufacturing and sell to other countries, when the Canadian dollar appreciates, gains in value, then for other countries to buy those goods, they become more expensive. So we try to manage our exchange rate so it's not purely flexible, so we can both simultaneously protect those manufacturing industries and companies that do a lot of export. As well, we still want, we don't want our currency to have too little value that we can't afford to import all those goods like food that we can't produce domestically. So what we try to do within Canada is we really try to target an exchange rate That's really about 90 cents US. The idea here is we just want to be a little bit cheaper than US companies so that they will buy from us. At the same time, we recognize that we do a lot of trade with the US. And so because of that, we need to be able to afford to buy US goods. So keeping it just below par allows that. But in order to do that, we can't have a purely flexible exchange rate. We have to manage it a bit, manipulate it a bit by changing the amount of money in circulation and those interest rates. And we do that because a purely flexible exchange rate is changed by changes in tastes and preferences, relative income, relative prices, and relative interest rates.